There's a pattern in economic history that repeats with mechanical precision. Not every decade, not randomly, but when specific conditions align. Extreme asset valuations, record debt levels, excessive leverage, widespread belief that this time is different, and a trigger event that forces liquidation. These conditions existed in 1929. They existed in 2008. And right now, in 2025, every single one of these conditions exists again. Not similar conditions, identical conditions. The stage is set. The players are positioned. And if history is any guide, the crash will come in late 2026 or early 2027. This isn't prophecy. This isn't doom-mongering. This is pattern recognition. Let me show you exactly how crashes unfold, who loses everything, who profits enormously, and why the 2026 crash could be worse than 1929 and 2008 combined. Because the scale is larger, the leverage is higher, the interconnection is deeper, and the people in power have used all their ammunition fighting the last crisis, leaving nothing in reserve for the next one. What I am about to show you is a documentary analysis of a crash that hasn't happened yet, but follows a pattern that has happened twice before with devastating accuracy. The mechanisms are the same. The timeline is predictable, and the outcomes, who gets destroyed and who gets rich, follow the same script every single time. Let me start with where we are right now. January 2025, the setup. Every crash begins with a bubble, and we are currently in the largest everything bubble in history. But it's not just stocks. Real estate in major cities is at all-time highs. Regional banks have massive exposure to commercial real estate. Community banks, regional lenders, they hold 20 to 40% of their loan books in CRA. When those loans default, banks must recognize losses. Those losses eat through capital. When capital falls below regulatory minimums, regulators close the bank. We've already seen this begin. Silicon Valley Bank collapsed in March 2023. Signature Bank failed the same week. First Republic failed in May 2023. These failures were blamed on interest rate risk. But the underlying problem is commercial real estate. If CRA defaults cascade through 2025 and 2026, we could see 50 to 100 regional bank failures. And bank failures trigger panic. Trigger 2, a major corporate bankruptcy or sovereign debt default. Hundreds of corporations issued debt at low interest rates during 2022-2021. That debt is maturing now. They must refinance at rates that are double or triple what they paid before. Some cannot afford it. If a major corporation, a Fortune 500 company, defaults on its bonds, it triggers contagion. Bond investors panic. They sell other corporate bonds. Yields spike. Borrowing becomes impossible. Companies that need to refinance cannot. More defaults follow. This is how the 2008 crisis spread. Lehman Brothers failed. Then everyone assumed other banks would fail. Credit markets froze. The same thing could happen with corporate debt. Sovereign debt default is similar but larger. If a major emerging market, Turkey, Argentina, Pakistan, defaults on dollar-denominated debt, it triggers questions about other countries. Can they pay? Investors sell emerging market bonds. Capital flees. Currencies collapse. More defaults follow. This creates a global credit crisis. Emerging markets hold trillions in dollar debt. If they cannot repay, banks that lent to them take losses, and those banks are often European and American. The contagion spreads from emerging markets to developed markets. One default triggers the cascade. Trigger 3, a geopolitical shock, war, pandemic, terrorist attack, election crisis, something that spikes volatility and forces investors to sell assets to raise cash. The COVID crash in March 2020 was this type of trigger. The pandemic wasn't an economic problem initially. It was a health crisis. But the uncertainty forced liquidation. When you don't know what's coming, you sell everything and go to cash. If another shock of similar magnitude occurs, war with China over Taiwan, conflict in the Middle East disrupting oil supplies, a contested US election with violence, any of these could trigger the same flight to safety that causes liquidation. Any of these three triggers could start the cascade, but the underlying cause is the same. Excessive valuations and leverage. The trigger doesn't matter much. Once liquidation starts, the mechanics take over. And those mechanics are brutal, predictable, and devastating. Let me walk through what happens once the crash begins. This is based on the 1929 and 2008 patterns. The timeline is compressed or extended depending on the speed of liquidation, but the sequence is always the same. Phase 1 is the initial shock. The trigger event happens. Markets fall 10 to 15% in days. Investors are surprised but not panicked. This is seen as a buying opportunity. Buy the dip. The Fed will intervene. Stocks are on sale. Media outlets interview analysts who say fundamentals are strong and this is temporary. In 1929, the initial shock was October 24th, Black Thursday. The market fell 11% in one day. Panic, but not catastrophe. Bankers met and pledged to support the market. Stocks recovered slightly. Everyone believed the worst was over. In 2008, the initial shock was March 2008 when Bear Stearns collapsed. The market fell 15%. The Fed arranged a bailout. JP Morgan bought Bear Stearns. Crisis averted, or so everyone thought. In 2026, the initial shock could be a major bank failure or a wave of corporate defaults. Markets fall 10 to 15%. The Fed issues a statement. We are monitoring the situation. The financial system is strong. We stand ready to provide liquidity. Investors buy the dip. Stocks recover partially, but the damage is done. The crack in confidence has appeared. Phase 2 is the false recovery. After the initial shock, markets stabilize or even rise. This lasts weeks or months. It's the most dangerous phase because it convinces people the worst is over. In 1929, after Black Thursday, the market recovered for a week. By early November, stocks were nearly back to pre-crash levels. Investors who sold felt foolish. Those who bought the dip felt vindicated. Then November 11th arrived. The market fell 13% in a single day. The real crash had begun. In 2008, after Bear Stearns collapsed in March, markets stabilized through spring and summer. By July 2008, the S&P was only down 10% from its October 2007 peak. Many analysts called the bottom. The financial crisis is contained. Housing has stabilized. Then September arrived. Lehman Brothers failed. The market fell 40% in 6 weeks. In 2026, the false recovery could last 3 to 6 months. The initial bank failure or corporate default is blamed on specific mismanagement. It's isolated. It doesn't reflect the broader economy. The Fed cuts rates modestly. Markets rally. Investors believe the crash is over. But beneath the surface, the problems are spreading. Phase 3 is the cascade. This is when the real crash happens. Forced liquidation, margin calls, panic selling. In 1929, the cascade lasted from November 1929 to July 1932. The market fell 89%. In 2008, the cascade was faster. September 2008 to March 2009, a 57% fall in 6 months. The 2026 cascade could be somewhere between probably 12 to 18 months. A 50 to 70% decline from peak to trough. Here's how the cascade works mechanically. Stage 1 of the cascade. Leveraged investors get margin calls. Investors who borrowed to buy stocks are forced to sell when stocks fall. They borrowed at, let's say, 50% margin. If stocks fall 20%, their equity is nearly wiped out. The broker issues a margin call. Sell now or we'll sell for you. These forced sales drive prices lower. Stage 2, institutional investors face redemptions. Mutual funds, hedge funds, pension funds. When their assets fall, investors demand their money back. The funds must sell stocks to raise cash. More selling pressure. Stage 3, algorithmic trading amplifies the decline. High-frequency trading algorithms see prices falling and accelerate the selling. Stop-loss orders trigger. Circuit breakers halt trading, which creates more panic when trading runs. Stage 4, liquidity disappears. When everyone is selling and no one is buying, there are no bids. Stocks gap down 10, 20, 30% because there's no buyer at any reasonable price. The market isn't declining, it's collapsing. Stage 5, credit markets freeze. When stock prices are falling and panic is widespread, banks stop lending. Why lend money when borrowers might go bankrupt tomorrow? Credit freezes. Companies that need to refinance debt cannot. They default. Banks that lent to those companies take losses. The cycle accelerates. During the cascade, the economy enters recession. Stock market crashes destroy wealth. About $30 trillion in market value could be lost. Consumers feel poor. They cut spending. Companies lose revenue. They lay off workers. Unemployment rises from 4% to 9 or 10%. Laid-off workers cut spending further. More companies lose revenue. More layoffs. This is the feedback loop that turns a market crash into an economic depression. Phase 4 is maximum panic. This is the bottom when fear is so extreme that people sell everything regardless of price. In 1929, the panic bottom was July 1932. The Dow at 41, down 89%, unemployment at 25%, banks failing by the hundreds. In 2008, the panic bottom was March 2009. The S&P at 66, down 57%, unemployment at 10%. Major banks insolvent and bailed out by the government. In 2026, the panic bottom could come in late 2027 or early 2028. The S&P, currently at 6,000, could fall to 200 or lower. Unemployment at 10%, multiple bank failures, government intervention. This is the moment of maximum fear and maximum opportunity. Phase 5 is the slow recovery. This begins when the government intervenes massively. In 1933, Roosevelt launched the New Deal, created jobs, reformed banking, and restored confidence. The recovery from 1929 took a decade. Stocks didn't reach 1929 levels again until 1954, 25 years later. In 2008, the government bailed out banks. The Fed printed $3 trillion. Congress passed stimulus. The recovery was faster. Stocks reached new highs by 2013, 4 years later. The full economic recovery took until 2015. In 2026, 2027, the government will intervene again. But the scale will be larger. The Fed will cut rates to zero. Congress will pass multi-trillion-dollar stimulus. Banks will be bailed out, but the recovery could be slower than 2008 because the debt levels are higher. Government debt at 120% of GDP. Adding trillions in stimulus pushes it to 150% or 180%. At those levels, debt service consumes tax revenue. The government faces difficult choices: austerity, raising taxes, or inflating away the debt. None are easy. The recovery could take 5 to 10 years. Stocks might not reach 2025 levels again until 2032 or later. This is the five-phase pattern. Initial shock, false recovery, cascade, panic bottom, slow recovery. Now, let me show you who gets destroyed and who gets rich. Because every crash creates massive wealth transfer from those who do unsee it coming to those who do. Who gets destroyed? The middle class holding stocks and homes. In 1929, the middle class that had invested in stocks lost everything. Families that had felt wealthy in 1928 were destitute by 1933. Their stock portfolios fell 89%. Their homes were foreclosed when they couldn't make payments. In 2008, middle-class homeowners who bought at the peak lost 40 to 50% of home equity. Many went underwater, owing more on mortgages than homes were worth. Some walked away, others were foreclosed. In 2026, the same thing happens. Middle-class families with 401k retirement accounts will watch them fall 50 to 70%. Bernard Baruch held cash in gold, bought assets at depression prices, and emerged wealthier than before the crash. In 2008, John Paulson made $20 billion betting against subprime mortgages. Michael Burr made $700 million. Warren Buffett made billions buying Goldman Sachs and Bank of America at crisis prices. In 2026, the same playbook will create the next generation of billionaires who profits, cash holders. The investors who sold stocks before the crash and held cash or treasury bills. When stocks fall 60%, cash doesn't fall. It gains purchasing power. You preserve capital while others lost half. Then, at the bottom, when everyone else is panicking, you deploy that cash. You buy stocks at 40 cents on the dollar. You buy real estate foreclosed at 50% of peak value. You buy businesses being liquidated. Warren Buffett held $325 billion in cash in 2024. When the crash comes, he deploys. He makes the same investments he made in 2008, except this time the scale is larger. He could make $100 billion or more. Short sellers profit. Investors who bet against overvalued stocks or sectors. In 2026, commercial real estate, regional banks, over-leveraged corporations. These are short targets. If you short a bank stock at $50 and it falls to $5, you make $45 per share. Hedge funds building these positions now will make billions. The exact same trade Paulson and Burr made in 2008. Gold holders profit. In 1929, gold was fixed at $20 per ounce. Then, in 1934, Roosevelt revalued it to $35, a 69% gain for gold holders. In 2008, gold went from $800 in 2008 to $11,900 by 2011, a 137% gain. In 2026, gold could go from $2,700 to $5,000 or higher. Why? Because when the crash comes, the Fed prints money, massive stimulus that devalues the dollar. Gold, which cannot be printed, appreciates. Distressed debt buyers profit. When companies go bankrupt, their debt trades at 10 to 30 cents on the dollar. Vulture funds buy this debt. wait for restructuring, and collect 50 to 100 cents. A $100 million investment becomes $300 million. Carl Icahn, Howard Marks, Oaktree Capital, they all made fortunes buying distressed debt in 2008. They'll do it again. Real estate investors who have cash profit. When foreclosures spike, properties sell at auction for 40 to 60% of value. Investors with cash buy entire portfolios. They rent them out, wait for the market to recover, and sell at huge profits. Blackstone did this in 2009 to 2012, bought 80,000 homes at crashed prices, made billions. Private equity firms profit. They've raised $2 trillion in dry powder, capital waiting to be deployed. When the crash comes, they buy companies being liquidated. They buy divisions of corporations that need to raise cash. They buy assets at 30 to 50 cents on the dollar. Then they hold for 5 years while the recovery happens, sell at full price. This creates generational wealth. The firms that see the crash coming and position before it happens create dynasties. This is the wealth transfer from the middle class that holds stocks and homes through the crash to the elite. Investors who sold before, shorted during, and bought at the bottom. It's not theft, it's not illegal. It's understanding the cycle. Crashes don't destroy wealth. They transfer it from those who don't see it coming to those who do. Let me compare the 2026 crash to 1929 and 2008 directly. What's the same? What's different? What's the same? The bubble mechanics. All three started with asset prices disconnected from fundamentals. 1929 stocks at 30 times earnings. 28 homes at 5 times incomes. 2026, everything at record valuations simultaneously. The leverage is the same. Margin debt in 1929, subprime mortgages in 2008, corporate debt, consumer debt, government debt, all at records in 2026. The belief is the same. This time is different. Permanently high plateau in 1929. Housing never falls nationally in 2008. The Fed woe, and let markets crash in 2026. Every bubble believes it. It's different. None are. The cascade mechanics are the same. Forced liquidation, triggering more liquidation, credit freezing, panic selling. These are mechanical processes, not emotional. Once leverage reaches critical levels, any trigger starts the cascade. The wealth transfer is the same. Those with cash, gold, short positions, they profit. Those fully invested, leveraged, unprepared, they're destroyed. This pattern hasn't changed in a century. What's different? The scale. 1,929 US stock market capitalization was $80 billion. To 2008, 12 trillion. 2026, 50 trillion. The scale is 4 times larger than 2008. The losses could be 30 trillion. The speed 1929 took 3 years to reach bottom. To whiz 8 took 6 months. 2026 could be faster. Algorithmic trading, global interconnection, instant information, everything moves faster. The crash could happen in weeks instead of months. The global interconnection, 1929, was primarily an American crash. Spread to Europe, but slowly. 2008 was a global crisis, but emerging markets recovered quickly. 2026 will be truly global. China, Europe, emerging markets, all interconnected. A crash in one region spreads instantly to all regions. There's no safe haven. The government's capacity to respond. In 1929, the government did nothing initially. In 2008, the government had tools. Interest rates at 5%, room to cut, fiscal space to spend trillions. In 2026, rates are already low. Government debt is already 120% of GDP. The Fed's balance sheet is already massive. There's less ammunition. The response will be larger, but less effective. The social consequences. 1929 created political extremism, the rise of fascism in Europe, communism gaining support. 2008 created Occupy Wall Street, Tea Party, political polarization. 2026 could create something worse. The wealth inequality is extreme. The middle class has been hollowed out. If the crash destroys what's left of middle-class wealth, the political consequences could be revolutionary, not hyperbole. Historical pattern. When crashes destroy the middle class, political systems become unstable. Let me show you the timeline. This isn't a prediction of exact dates. This is a pattern-based projection. Early 2025, we're here now. Markets at all-time highs, valuations extreme, leverage at records. Investors believe the Fed will prevent crashes. Mid-2025 to early 2026. The trigger event. A wave of bank failures, major corporate bankruptcy, geopolitical shock. Markets fall 10 to 15%. Phase 1, initial shock. Spring 2026, false recovery. Markets stabilize or partially recover. Media declares the crisis over. Investors buy the dip, but the problems are spreading beneath the surface. Summer to fall 2026, the cascade begins. Defaults accelerate, credit freezes, markets enter free fall. Fall 50% over 6 to 9 months. Late 200, 6 to mid 2027, panic bottom. Unemployment at 10%. Banks failing. Government intervention begins. Fed cuts to zero. Congress passes stimulus. This is the moment of maximum fear. Late 2027 to 2030, slow recovery. Markets stabilize, then rise. Economy recovers slowly. Unemployment falls. But stocks don't reach 2025 levels again until 2030 or later. This timeline could compress or extend by months, but the sequence is locked. The pattern says the crash happens late 2026 or 2027, and the pattern has been right twice before. What should you do with this information? This is not financial advice. I'm not a financial advisor, but pattern recognition suggests several strategies based on what worked in 1929 and 2008. 1. Reduce stock exposure. If you're 100% invested in stocks, reduce to 50 or 60%. Hold the rest in cash or treasury bills. You'll miss some gains if markets rise, but you'll preserve capital when they crash. 2. Hold 5 to 10% of your portfolio, physical or ETFs. When the crash comes and the Fed prints money, gold will surge. 3. Identify quality companies you want to own. Make a list. Apple, Microsoft, Berkshire Hathaway, Visa, Johnson & Johnson. Companies with strong balance sheets and low debt. When the crash happens, when these stocks fall 50%, buy them. 4. Prepare psychologically. The hardest part isn't the strategy. It's having the courage to buy when fear is maximum. In March 2009, it felt like the world was ending. Buying stocks felt insane. But that's when fortunes were made. Prepare mentally now so you can act then. 5. Protect your income. If layoffs are coming, make yourself valuable. Reduce personal debt. Build an emergency fund. If you lose your job during the crash, savings will keep you afloat. 6. Watch the indicators. Commercial real estate default rates, regional bank stocks, high-yield bond spreads. These will signal when the cascade is starting. When you see these indicators deteriorate, it's time to get defensive. The 2026 crash isn't certain. It's possible the Fed engineers a soft landing, that valuations gradually normalize, that leverage unwinds slowly instead of explosively, but the pattern says otherwise. Twice before, when conditions align like they are now, crashes followed. Devastating crashes that destroy the unprepared and enrich those who saw it coming. The setup is complete. The bubble is inflated. The leverage is extreme. The belief in permanence is universal. We're waiting for the trigger. And when it comes, the 5-phase pattern will play out. Initial shock, false recovery, cascade, panic bottom, slow recovery. Wealth will transfer from the middle class to those positioned correctly. Lives will be destroyed, fortunes will be made. And in 10 years, economists will write papers analyzing why no one saw it coming, even though the pattern was obvious. If this documentary showed you a pattern you'd never seen, if you understand now that crashes follow predictable sequences, if you recognize that 2025 looks like 1928 and 2007, then you have a choice. Ignore the pattern and hope this time is different, or recognize the pattern and position accordingly. The pattern doesn't guarantee the crash, but the pattern has been right twice before. And the pattern says late 2026 or 2027 the crash comes. The Great Depression, the financial crisis, and coming soon, the 2026 crash. 3 times. Same pattern, same sequence, same wealth transfer. The only question is whether you'll see it coming or learn the pattern the hard way. History is clear. Those who understand the pattern survive and profit. Those who ignore it lose everything. The setup is complete. The pattern is repeating. The crash is coming. What you do with this information will determine which side of the wealth transfer